My name is Don Wright. I'm a Senior Investment Manager at Henderson, Rowe, and it's my pleasure to welcome you to our latest webinar. I'm joined by my colleague, Dr. Phil Wool, Head of Investment Solutions at our parent company, Rayliant Global Advisors. Hi, Phil. Thanks for joining me.
Hi, Dom. Great to be speaking with you again.
We've just released our quarterly commentary, so today we're going to be discussing some of the themes that have emerged over the last quarter and what this means for equities, fixed income, and alternatives such as commodities and property. Investors will remember the beginning of 2020 for a long time. Regardless of how the situation unfolds the rest of the year, we know that most of us have not seen such volatile markets for a very long time. In fact, for those who started investing after 2008, this is the first experience with a bear market. Back in March, the market signaled that the global economy was on the brink and a liquidity crisis threatened an avalanche of insolvencies and bankruptcies. Central banks stepped in quickly, boosting and maintaining liquidity in treasury and corporate bond markets. This support, combined with a range of coordinated fiscal stimuli around the globe, allowed the markets to find the bottom and stage one of the sharpest short-term rallies in history. Taking the behavior of stock markets as an economic indicator, one might get the impression that the world economy is in a good place right now. Unfortunately, it is the exact opposite. The global economy today finds itself in a crisis not yet witnessed in the 21st century. So, Phil, in our market overview, we talk about how the financial market staged a remarkable comeback in Q2, whilst the global economy is still in a crisis, largely due to extraordinary gains made in the tech sector. And while we don't believe we're in a bubble, some parts of the market are beginning to exhibit bubble-like characteristics. And there's a particularly good line in our notes, which is every good analyst knows that a stock's price reflects a mix of its discounted cash flow valuation and the optionality of selling it to someone else at a higher price. Can you just elaborate on that, please, and what it means for our investment process in this tech-led rally?
Yeah, so you referenced bubbles, and I think the thing to remember about bubbles is that they're notoriously hard to identify when you're in the moment, but then in hindsight, they look completely obvious. So there's definitely a big risk in trying to call the top of the market. And if you thought that 2 years ago stocks were overvalued and there were plenty of smart people who thought exactly that, you would have missed out on a big rally. And we show some of the performance in the last quarter in the note. Now, just because we're not trying to time the overall market, I think it would be wrong to say that we're not looking at pockets of the market, as you suggested, and asking ourselves if we can justify current prices with fundamentals. And if we can't, then I think with respect to our investment process, it just means that we need to be maybe choosier when we're in those parts of the market. So if you looked at U.S. internet stocks, and we've got a chart on that in the note, you'll see that they're trading at around 160 times earnings right now, although over the last 10 years, they were pretty stable at about 50 times earnings. That's clearly pricing in a massive amount of future growth. It doesn't mean that every tech stock is overvalued, but if we look at the market like rational analysts, we know that at least at some point in the future, these companies have to earn much more than they are right now to justify those valuations. And if you find a company that's trading at 2,000 times earnings, you have to ask yourself, how much more growth would we need to see in the future for the price to actually increase from here? So for a stock like that, I'd argue there's probably a lot more downside than there is upside, and we might be able to find bigger bargains elsewhere in the market. So I would say one of the things that this highlights is a trade-off that we have to make as investors when we're balancing capital growth, which is obviously one of our objectives, with another objective, which is capital preservation. And we clearly don't want to miss out on huge growth opportunities in younger companies or in companies or industries that are undergoing radical change and possibly change for the better. But we need to balance those hopes against keeping part of our approach deeply rooted in companies' fundamentals. So ultimately, that means that we've got to be really good both in terms of the quantitative research, but also the fundamental research in terms of picking out growth that investors might actually be underpricing.
Excellent, Phil. I think that was very very insightful as always. And I guess it's just making sure we're avoiding that kind of greater fool theory. I suppose when we're sort of selecting the companies here, that there's sort of fundamentals behind the business to kind of warrant their current price, which is obviously very important. Tech's been a clear winner in 2020 at the sector level, and also at the regional level. We've seen the US has strongly outperformed Europe and emerging markets. Why do you think the UK has been such a laggard in 2020 so far?
So to some degree, I think UK stocks' lackluster performance last quarter is really about weaker than expected growth. The economic rebound in the UK has been pretty disappointing so far relative to other big economies. It was one of the worst performing stock markets when you look at major global indices last quarter. I think Brexit uncertainty, that's clearly impacting businesses in the UK, and that's not going to help matters. But I think you kind of touched on this a second ago when you mentioned tech rallying. And I think it's pretty clear that industry exposure in the UK is another part of the story. So if you look at the weight of different industries in various global benchmarks, and we could look at the beginning of the second quarter. So 3 months ago, before tech stocks made this big surge, if you looked at the FTSE 100 at that point in time, only about 1% of the weight of the index was in information technology, which has clearly been a big winner throughout COVID-19. And on the flip side, if you look at the exposure to energy and materials, that was about 20% of the index. And we know that those are two of the biggest losing sectors. And then contrast that to the S&P 500. The S&P at the end of March had a 25% weight in tech. And only about 5% combined in energy and materials. So a big part of that differential is clearly coming from different industry exposures. Now, for investors, what's the implication of that source of this discrepancy is really something that's come up again and again in the last 6 months, because we've been in an extreme market environment, and that is diversification and the fact that you really need to have broad industry exposure. Part of the way that you achieve that is you have to make sure that you don't have too much weight in particular markets like the UK, where industries are biased away from where we think a big part of growth might be coming from. Now, that's not to say you don't want to be invested in UK stocks. The point is just that you want to make sure that that exposure doesn't distort your overall portfolio in terms of fundamentals or in terms of risk.
Absolutely. So I think particularly for our clients who are kind of mainly UK based, it's, as you said, very important to not have that kind of home country bias in your investment sort of approach as well. Another sort of fascinating part of the note was the textual analysis chart that we highlighted from the Federal Reserve study on language used by companies in conference calls. And that shows how Business Insiders seem to be more apprehensive than the broader market might indicate. What should we conclude from that? Is it that businesses are simply telling analysts what they want to hear, or does it indicate that the market is perhaps being too complacent?
I think it's a good example of trying to use big data to help us validate views that we've developed looking at the more traditional macro numbers or looking at individual companies' accounting statements, for example. One of the things that we know from unemployment figures or industrial production, and we've got a chart on that in the quarterly note, or really any number of economic stats, we see that COVID-19 clearly delivered a huge blow to global growth. That's having a huge impact on individual companies. And then on the flip side, you can see from this Q2 rally in stocks that there's something of a disconnect between where financial markets trade on the one hand and then the news that we read every day about the real economy. Part of the explanation for that is that markets aren't reacting to current economic data, or at least they're not exclusively reacting to what we see in the news every day, but they're also taking into account the expectations of all of these market participants about what's going to happen in the future. So even before you see a rebound in the economy, stocks are going to start pricing that in. And that's why you might see a rally in stocks, even though the recovery doesn't yet seem to have taken hold. Now, getting back to the data on these conference calls, this is exactly why hearing what managers are actually saying about the future is particularly interesting, because it tells us something about corporate insiders, and that the insiders at many companies have a less optimistic view. And that's very clear when they start talking about cutting dividends or drawing down on credit lines. Now, I think another implication for our investments is that, particularly with respect to that increased borrowing, companies mentioning that they're slashing future investment, this probably means that we need to temper our expectations when it comes to future growth, because companies just aren't planting the seeds for that growth right now. And in the future, when you think about this ballooning corporate debt, the costs of servicing that debt are likely in the future to crowd out spending on investment and companies' innovation. So this is once again sort of like those skyrocketing PE ratios. This is telling us that we probably need to be just as selective, if not more so, in terms of identifying companies that are going to be successful in managing those risks and maintaining growth in the face of all of these obstacles.
Very important, I guess. It sounds like, in a way, a lot of the kind of retail money, for instance, going into the market is really being kind of very complacent about that.
Exactly. Yeah, and it's a matter of recognizing that that tech rally that's pushing equity prices up, that's affecting a small subset of the market. But there's a much broader set of companies that are experiencing major challenges. And so being attuned to those risks and picking the winners from among that field of firms, there might be more bargains there. And looking at big data like conference call transcripts, that can help us a little bit to identify those firms.
Yeah, absolutely. And I think this sort of issue, I guess, of the kind of struggles that businesses are kind of facing, and that they're kind of communicating to analysts in conference calls, kind of leads into the sort of fixed income section as well. Obviously, not just on the corporate side, but obviously the kind of government side as well. We've seen massive monetary stimulus over the past few months. Rates were already low, and they've only gone lower. What are the implications for that for investors in fixed income markets now?
So I would say, as far as asset classes go, debt markets in the second quarter are probably the easiest one to understand, because the theme here has really been pretty much the same for a long time. You've got the Fed and other central banks, and they're just pumping liquidity in the market. It's driving fixed income prices up, which means yields are going down, as you suggested. Maybe in the second quarter, one of the more interesting developments, again, gets back to how these intuitive perceptions that we've got of risk seem to be diverging from the way that bonds are actually priced so far this year during the pandemic. What we've seen in the last few months, when we look at data on credit markets, is that the economic damage from social distancing and lockdowns and these other public health measures, and this is sort of what we expected was going to happen, it's starting to affect businesses to the point of impacting companies' creditworthiness. So you're starting to see the effects of this show up in credit markets. And one of the ways that that's manifesting is a barrage of ratings downgrades. And what we know from past history is that ratings downgrades usually precede higher rates of default by some issuers. Now, at the same time, we see downgrades and this expectation for future defaults. If you looked at credit spreads on high yield debt, which initially spiked in late March when pandemic fear was at its peak, they've come down since then. So now when you look at the riskiest bonds, they're not pricing in as much risk as they were before. Now, the reason for that, of course, is that central banks and governments are intervening explicitly to support credit markets. So in some sense, it's actually rational for investors to accept lower returns on high yield debt because there's some safety in this backstop by central banks and governments. But on the other hand, the upshot is that you can't get much yield from bonds right now. And that's certainly the case if you think about the potential risk that the crisis could deepen and that maybe central banks' level of commitment, or at least their approach to the market, might change. But again, it doesn't mean that bonds aren't going to continue to be an important part of investors' asset allocation. It's just that when we buy bonds in the current market, we're going to be doing it less for income and more using bonds as a way to calibrate investors' overall level of volatility in the portfolio. So we know that if we buy safe, high-quality bonds, then we'll enjoy less upside, and we're certainly not getting much income right now. But we're also going to see a more stable stream of returns from the overall portfolio, and there's going to be considerably less downside risk.
I think that's an incredibly important point there, isn't it? Because too many people have sort of used the kind of bond side of their portfolio to kind of really sort of chase yield, and they felt sort of with interest rates so low, that's where they want to go to sort of generate some income. And I think it's very important that our view is that it's there for reducing volatility, not as a way of bringing in some income, I guess. Our final section of our note is where we talk about commodities and property. And we've seen incredible volatility in alternatives this year. And the chart showing the relative performance of developed world property, gold and oil almost looks distorted given how skewed it is by the staggering 180% rebound in oil in Q2. And yet, despite that, it's still down 36% year to date. I'd like to focus a question here on inflation, as we had a number of questions about that in our recent virtual investor lunch. Should we be rapidly reorienting our portfolios to fight inflation in light of that huge central bank stimulus?
Right. Yeah. So we've definitely talked a lot lately about inflation, and obviously you really have to at least think about inflation when you see trillions of dollars, not only in the form of monetary stimulus, but there's also a lot of fiscal spending going on, and governments are borrowing a lot of money to make that happen. And as you suggest, one of the things that investors are trying to figure out is, suppose that we believe that there is going to be inflation, what can we do to shield our portfolios from the destructive influence of inflation? And if you look back at history, and this is what we're trying to accomplish with the simple analysis that we did in the quarterly note, we've definitely had episodes of inflation in certain countries, but you have to go back all the way to the late 70s in the US to get back to the last serious bout that we've had with inflation. And you can take a period like that and you can look at how different asset classes performed when you saw a spike in the CPI. Stocks certainly look a little bit worse, and bonds are clearly a terrible place to be when you've got big inflation. And one of the things that we confirmed in that analysis is this intuition that alternatives like property or even more significantly commodities can protect against inflation. The intuition there is absolutely right, and you can see that in the case of commodities, they actually slightly outpace inflation during that one period that we've got in this simple historical analysis. But I think in terms of lessons for investors, a more important takeaway from this analysis, and it gets back to the trade-off that I mentioned at the start of our conversation, it's that when you're in a period of normal growth in prices, so you're waiting for inflation to kick in, and I think that's where we were after the global financial crisis, and we actually didn't see that inflation. And this seems to be where we sit at the moment. Assets that we think are going to provide the most protection against inflation, like commodities, have much lower returns than equities. And commodities in periods of normal inflation actually had lower returns than bonds. So if you think about alternatives, almost as an insurance policy against inflation, then you also have to acknowledge that that you're going to be paying a steep premium to get the benefit of that peace of mind from holding those inflation hedges. And for investors, I think it's really critical that when we make decisions, particularly about changing our overall asset allocation on the basis of something like a fear that we have over inflation, when we think about those changes, we need to be fully informed, not just about the benefits of owning something like commodities, that they might help to hedge against inflation, but we also need to recognize the costs. So if an investor is comfortable foregoing some of the upside, like that big rally we talked about in US tech stocks, then it could be the right decision to buy commodities. And I think part of what makes investing interesting, but also very challenging, is that we're constantly having to weigh trade-offs like that. And it's especially difficult because we don't actually know exactly how the future is going to play out. So we have to make these sorts of decisions, and we have to weigh these costs and benefits under uncertainty about the future.
Yeah. And I think you can only make those decisions if you've got the data and if you can, kind of make the kind of sensible conclusions from it. Sort of hugely useful for all of our clients. Looking ahead, we highlight that as investors have already priced in long-term growth assumptions for some, not all tech and growth stocks. Potentially, we will identify good businesses within the old economy, as they will offer a better risk-reward premium. And you sort of touched on that earlier. Clearly, we don't want to be so contrarian that we miss out on further potential gains in growth stocks. So there's a balance to be struck there. And I think that's probably best summed up by an email that Dr. Jason Hsu, chairman and CIO of Rayliant, sent us internally this week. So he writes, do I think Amazon is expensive relative to the S&P 500 or China large cap index? I do. Do I think Amazon will keep outperforming given its strong sentiment, positive momentum in a tech rally? I do. That's what makes investing so interesting. Our research, which looks at mid to long horizon returns, focuses more on fundamental signals based on valuation and earnings growth predictions. Our research, which focuses on getting short-term return patterns right, hones in mostly on price, volume, and sentiment patterns. So if you don't want to be completely destroyed in a growth rally fueled by a massive decline in discount rate and optimism regarding growth, then you cannot focus just on valuation for rational growth projections. Finally, always be fearful of the market. It has a wicked sense of humor. It likes to pull pranks on the most confident of us. And I think that email kind of really summed up, what we talked about earlier, Phil, the line from our note of every good analyst knows a stock price reflects a mix of its discounted cash flow valuation and also the optionality of selling it to someone at a higher price. Phil, as ever, thanks very much for joining us today.
Thanks, Dom.
Thank you for joining Henderson Rowe for this informational webinar. Our compliance department has asked me to note that this communication does not constitute a financial promotion as defined by Section 21 of the Financial Services and Markets Act 2000. The information contained in the video represents the opinion of the speakers and does not necessarily reflect Henderson Rowe's views. Nothing in this webinar represents investment, tax, legal, or other advice by Henderson Rowe. Our listeners should always remember that investing involves risks and it isn't for everyone. The value of investments can go up as well as down, and investors may not get back the amount invested. Investors should also be sure to understand that past performance is not an indicator of future performance. Henderson Rowe is a registered trading name of Henderson Rowe Limited, which is authorised and regulated by the Financial Conduct Authority under firm reference 401809. Thank you again for joining us today. Until next time, this is Dom Wright wishing you well.